if over the next 6 months or a year we see gold go up to, some minimum high like 8,000, which by the way, JP Morgan has now come up and said 9,000 2 months ago as an
Mhm.
ultimate. We think 8,000 is ridiculously cheap still because that just matches the two prior bull markets that occurred in the last 50 years. There were eightfold moves.
And so right now, gold to me is in this, to me, short term wise, it looks like it has put in a major top. I don't want to hold it. We got out way up here before that drop, but now it could potentially build a giant bull flag here. And who knows? Maybe it takes a year. And then, of course, if it starts to break out and it shows signs, then you definitely want to get long and catch that next move up. But what we don't want to do is hold on to something that clearly shows it has run out of steam.
Gold has fallen more than 13% so far in March, putting the metal on track for its worst monthly performance since 2008, as surging energy prices have heightened inflation concerns, prompting markets to reassess their interest rate expectations. OCBC analysts said gold's rebound from last week's lows appeared to be largely technical, especially with prices down sharply since start of the Iran conflict in late February. They noted that bearish momentum appeared to be showing some signs of easing, with gold's relative strength index recovering from oversold territory. Renowned market strategist and technical analysts MichaelOliver and ChrisVermeulen gives insights on gold, silver, and the broader commodity complex. MichaelOliver emphasizes that silver remains significantly undervalued compared to gold, despite already showing signs of strength. He further expresses that key price levels, such as gold reclaiming major highs and silver moving back above resistance zones, could trigger a powerful acceleration phase. According to him, once these breakouts occur, short positions may be forced to cover rapidly, fueling a sharp upward move. In his assessment, Oliver mentions that both silver and mining stocks have begun breaking out of long-term underperformance trends. Looking ahead, he predicts that silver could reach dramatically higher levels, potentially entering the $300 to $500 range over time, driven by both monetary demand and capital rotation out of weakening financial markets into hard assets like gold and silver. If you're ready for unfiltered truth and sharp market analysis, hit that subscribe button. Let's explore the latest insights from MichaelOliver and ChrisVermeulen's recent interview.
Look at the 2011 high on that chart there. It got up over 3%. Divide an ounce of silver into an ounce of gold, it was 3% plus. Right now we're above one. It's still cheap versus gold. And it is a monetary metal. Don't let thousands of years of history go by. It's a
Yeah.
monetary metal. And there were same things going on with the miners, the XAU index versus gold down below and the Huey versus gold. They both broke out of relative performance situations too. So they're saying, hey, buy silver and buy the miners. Yes, gold is the mama, but we're going to outperform the mama market
Yep.
within the
Yeah.
complex. Now look at the gold chart below. Go to the next page. Just simple, stupid price chart. Okay. Well, we're higher than that right now. In fact, if you factor in that we're rotating to June gold, then we're well above that last reading. But there's 3 months up there effectively stalled at the same price level. You get up to 53, 5,400. There was one spike above 55, but basically, at 3 months pounding the same level. Gold doesn't peak that way. If you go back to 2011, when you made your high in September, I think it was 2011, you dropped from 1900 down into like the 1500s. You never
Hmm.
came back anywhere close to the 1920 price high. You
Hmm.
came up into the 1700s again, but you couldn't get back up to the old high. Well, if
Hmm.
you internally look at gold on a daily chart, anybody who's watching this right now, go to your quote screen, punch up a daily continuation of gold, you'll see that the peak daily close back in late January was just above 5,300.
Hmm.
Early this month, we had a peak daily close just above 5,300. In other words, not only does monthly price chart go back up into that supposed thin air, but the daily price close went back up and effectively matched the peak close of January. In other words, the air is not as thin as you think up here. You shouldn't have been able to go back to the high again. We're saying now you go back to 5,300 gold again, they're going to blow your head off.
Yeah.
And for silver, we think the key level is getting back over 90 again. And we're talking price now, not
Yeah.
momentum will give you earlier signals. And those are in our reports. But for just a price chart guy, if you want to know when this quote correction is over with, which has really been a violent sideways consolidation if you look at it. You get back over 90 on silver and you get gold to 5,300. You better cover your shorts or you're going to wet them because they're going to blow at that point. And
Yeah.
you're going to get the acceleration that we expected in this couple quarter surge. And consider what you saw in late January to be the midpoint correction.
Got it.
Time wise, I think silver could be $300 to $500.
That's
You
a
get back.
beautiful thing.
Yes, no. And the factors in play are both the monetary aspect, because if during that same time we see those S&P charts, one, have a little bounce now, waste some of late March, early April, maybe a couple weeks here, have a nice rally because the Iran thing abates or whatever. And then you roll back through those annual and quarterly structures we showed. You're going to have a blood flow. And already some smart money's been moving into what? Not T-bonds,
Yep.
gold and silver.
Gold and silver.
Okay. You'll have a massive money flow out of that broken bubble into gold and silver once it becomes a public awareness that, oh my gosh, it's really broken.
Yep.
And the central bank will go berserk. And we already know, the new Fed chair is going to go berserk.
Yeah.
Yeah. Okay.
No, I like that you marry everything too. Not only the technical, which is what you're known for, but also just the fundamental here. And I do have that same expectation as the stock market tops out. They got to keep this thing going. They just got to keep it going. That money flow's got to go somewhere. And how are they gonna prime prime it?
Watch, by the way, one thing we pointed out back in October, and since then we've updated and updated. Everybody's looking at AI. Yes, AI ultimately will lead the downside. The leader in the prior bull usually will lead the downside, mean suffer more.
Right.
But it's only been AI was only the leader in the last 3 years of that bull market, not since 2009, but only in the last couple of years has AI really been the leader. What you got to watch is financials. And we've been watching them, and they've been bleeding badly. Not in a collapse. No. But badly technically, where those structures that we showed on S&P, like the quarterly momentum, they've already blown those structures. Some key banks have blown those structures.
And think about that.
Yeah, that is what upsets the Fed more than anything.
Yeah.
So are they going to go berserk? You bet to you they are.
Yeah. Think about that. No, that's great insight. Yeah, I mean, I think you really nailed it here too. Talk to me about page 6 here on your report here.
Well, these are shorter term, and there's levels that we're toying with right now, and this is last week, so they're not up to date. You don't have to hold on those charts, by the way. There are near-term momentum factors, things like weekly momentum, not the monthly things that we were looking at before, and annual momentum and so forth, but where you measure silver and gold versus very short-term metrics to try to define when a short-term sell-off is turning back up. So, for example, silver early this month was what, $90 early in the month again. It closed the day up there. And then you started down. Well, when it came down into below 80 again, we said there could be a break. Sure enough, there was. And the break ended up taking out the February low. Well, the miners are vastly undervalued historically to gold. In other words, if you take the XAU index, which has been around since the 1980s, like GDX hasn't, it was only around since 2006. So take something that's been around a while. An XAU index, if you divided the price of XAU, which is the Philadelphia Gold and Silver Miners Index, by the way, and divided into 1 ounce of gold, you'd see that from 1980s, 90s, up through 2008, so for several decades, its average valuation divided into gold was 25%, which was always worth 25% of an ounce of gold. 1 share of XAU. Sometimes it was 35%, and it had lows like in the 17, 18%. But on average, during that multi-decade period, 25%, let's call it average valuation. You know where it collapsed to in 2015? 4%. What do you think? It's going to be free? Okay.
Right.
They're the people that get it out of the ground. And they were worth 25% on average. And now, then 2015, 4%? Give me a break. Okay, right now they're worth like 7.5% to 8%. Okay, by our metrics, XAU versus gold spread chart and Huey versus gold have both emerged enough in recent months to break out of the basing pattern that they had since 2015, indicating, hey, we're alive. We want to go to a normal valuation to that which we dig it out of the ground. Okay. Well, heck, even the bottom end of that multi-decade range of relative value of XAU to gold was 17.5, 18%. Well, right now, that's more than a double in their relative value just to get to the bottom
Right.
of the prior multi-decade valuation zone.
Yeah.
Doubling in value. Meaning, if over the next 6 months or a year we see gold go up to, some minimum high like 8,000, which by the way, JP Morgan has now come up and said 9,000 2 months ago as an ultimate. We think 8,000 is ridiculously cheap still because that just matches the two prior bull markets that occurred in the last 50 years. There were eightfold moves. Ours is right now at, let's call it, we started from 1,050. You do the math. 8,000 would match those moves. Okay. Merely match them. But if you took gold to 8,000 and doubled the value of the XAU index from where it is now, it would be like a tripling in the price of XAU. So
Think about that.
we think the potential for silver to gain versus gold, which is still very cheap versus gold historically, and miners versus gold is enormous. So yes, watch the mama market, gold, but the children are about to surge in front, okay, or the puppies, whatever you want to call them. They're about to regain value
Yep.
and go back to some normality, not even excess, in valuation, which would take their price off the page.
During the interview, ChrisVermeulen explains that the market has entered a choppy, trendless phase, where prices move sideways with high volatility, making it risky for long-term investors. According to him, major indices like the S&P 500 and NASDAQ are showing signs of topping, while the dollar breakout could pressure both equities and metals. He predicts that markets are at a critical turning point and emphasizes that for most investors, the best strategy right now is to stay cautious, avoid the noise, and wait for clearer opportunities. Concurrently, Vermeulen says gold has already priced in much of the bullish news and may have formed a major top. He explains that in a broader market sell-off, gold and silver can fall alongside equities, losing their short-term safe haven appeal. He mentions that technical signals pointed to exhaustion, which is why he exited near the highs. While still bullish long-term, he believes gold now needs time to reset before the next major move higher. While inflationary concerns and high interest rates can cause temporary fluctuations, the fundamental driver for the long-term upward trend is a shift in sentiment towards holding physical gold in a high-risk world. Let's jump into the interview.
Our position isn't what most people's position is, right? So about a month or so ago, we moved out of the equities market. So we flat. When the market gets like this, when it is like the stock market, for example, is trendless, like really it traded sideways in a range. The S&P 500 and the NASDAQ pretty much from the October highs. It's been like 6 months of just noisy chop. And when the market does that, you want to step aside. And so that's what we did quite a while ago. I mean, we actually exited our gold and silver when positions when silver was up at 113, gold was well over 5,000. And when the market was giving all of these signals, that's when we took action. And so all of this noise that's going on right now, we are completely sidestepping it. We're watching it from the side. We're just collecting daily interest safely as a position because we don't want to get involved with our portfolio in this type of noise. Now, there is opportunity, obviously, if you're an aggressive, active trader. But as an investor, somebody looking to protect their capital, who just wants consistency, they don't want to wake up every morning, hoping and praying the market didn't move against them, because this market right now is very dangerous. We got the S&P 500 breaking down from what looks to be a topping pattern. The NASDAQ is doing the same. We've got the dollar index trading at the 100 level on the verge of breaking out and rallying. If the dollar breaks out, that probably means we're going to see precious metals sell off. We're going to see equities crashing. So we're at a really critical turning point. The best position as a kind of a large investor trying to manage your wealth and your lifestyle really is to just sidestep this. Don't get caught up in the news. Don't think you need to trade this. This to me should be watched from the chair, watching through the screen, not actually diving in and trying to pull money out through this type of volatility. It's just not my style. I know it works for some, but that's not what I focus on. Gold has been doing what it should do for the last several years. It's been going up. Tensions have been rising. Things have been looking more bleak. And that's why we've seen both gold and silver moving higher. Now, the typical kind of scenario when it comes to the stock market or investing in general is it's like buy the rumor, sell the news. I think gold has been moving up with anticipation of all kinds of things falling apart. War kicked in. I mean, I think we went into this capitulation top. So gold did what it was supposed to do, but now we've hit this tipping point where I feel like it's put in a significant high, and now it's going to start moving with the stock market. And this is the fear: if the stock market sells off, then we're probably going to see precious metals sell off. And this is what I've talked for a long time: is not many things are safe when we go into a financial crisis or a bear market. And so we are seeing, I think a lot of people got rattled on this move. A lot of people who have held through here, they're really starting to panic and feel the pain. And now we're just seeing it move like the stock market, because I think the safe haven play is somewhat moved out. There's so much volatility, it doesn't feel that safe anymore. And it looks like it's got a pretty major top in the price action. Now, if we use Fibonacci extension, just based on this initial drop and this bounce to the upside, we can see that gold ended up hitting our target. And I'm not sure if you and I, we talked about this a long time ago. These are inside bars. We have this big red bar, and then all of these days coming all the way up to the top. And I talked about how this is a bearish price pattern. If it gets rejected at the top of this bar, look out below, because it's going to sell off and it's going to want to come down to the 618 or this previous low and down to the 100% measured move. And that's what it's done. And so right now, gold to me is in this, to me, short-term wise, it looks like it has put in a major top. I don't want to hold it. We got out way up here before that drop. But now it could potentially build a giant bull flag here. And who knows, maybe it takes a year. And then, of course, if it starts to break out and it shows signs, then you definitely want to get long and catch that next move up. But what we don't want to do is hold on to something that clearly shows it has run out of steam, that is not the play that it used to be. It's not that safe haven play right now. And it could actually unwind and come on down a whole lot lower. We could see 3,600 fairly easy in gold, I believe. So right now we are in this pause mode. And I mean, I was with you in at VREC in Vancouver when these prices were spiking. And I mean, I was on the panel saying, like, listen, I think we're going to see at least a 30 to 40% pullback in silver. I think we're going to see a big 20+% pullback in gold. All the signs were there. I was talking to people on the floor that had never bought metals before, and they had just bought silver at like 110 and all this stuff, or 106 or 108. And so when all these signs are there, you got to be cautious. And then prices now confirm that. So my view on gold right now is it's not a trade. It's just let it mature, let it build a pattern. And if it collapses and goes into a huge sell-off, it'll become an amazing buying opportunity, because long-term, I am extremely bullish on precious metals. All the fundamental data, all the economic data, everything going on, the central banks is the most bullish sign ever, but it doesn't mean price is going to just keep going up. It will have these corrections. So we just need to let gold figure itself out. And you're right, when we have broad market selling, it will move with the price of the stock market. And that's why a bear market is broad market selling. It's everybody's scared, everybody's selling everything. And that's the phase that gold and silver are in right now. So I think if you're a long-term gold investor, you either have to ride out more of a roller coaster, or you just got to give it time and it will recover. But it might still take a long time. The price pattern that we have is actually very similar, especially in silver, to what we saw in 2011. Where everybody, thought metals were going to the moon, and then it took 10 years to come back. It sold off. I'm not saying that's going to happen, but you definitely don't want to waste 2, 3, 5 years waiting for metal to come back when you could move somewhere else and not have to watch your account go down. You could potentially buy it at a lower price or buy it later as it's starting to go higher, so that you can just catch the upswing and not have to ride the wasted time in the roller coaster.
Gold prices are expected to continue rising, with analysts forecasting a push towards $6,000 by late 2026, driven by sustained central bank buying, heightened geopolitical tensions, and trade tariff uncertainty. While experiencing short-term volatility, the long-term outlook remains bullish as investors seek safety, potentially exceeding 2025 record highs. Regarding this volatile environment, will investors remain patient through the correction and position for the next breakout, or will continued market stress force even more selling before the true bottom is formed? Let us know what you think in the comments. If this video brought you any knowledge, give it a like, subscribe, and ring that bell so you're always in the loop. See you in the next video.